Alright, my name is Morgane, and I had to do a financial analysis on three industries: the energy industry, the utilities industry, and the advertising industry. So first, I started with the energy and equipment industry. The first company we're going to look at is Halliburton. As we all know, probably Halliburton has suffered from the BPO, but it's surprising to see that overall they did not suffer as much. If you see the liquidity ratio, so from 2008 to 2009, it went up and then it went down until 2012, but from 2012 to 2008, there is an improvement in 2012, so the company is still doing all right. In 2011, it dropped a little bit. It's because they have a lot of fine to pay with a lot of legal suits and the BPO incident. So the assets management, it went down. The return of earnings on earnings went down. Makes sense. I mean, they had a lot of things to pay off, but they're still doing all right compared to the industry. And you can see that the ROA as well is okay, meaning like they still have good sales over the assets. And the assets turnover, it's above 1, which is good for the industry. They have a low assets turnover in general. Their market value and expected price earning, they don't have a lot of leverage, which is typical from their industry. You see, they have a leverage of only 11%, 11.5%. So they get their money mostly from the shareholders. Price per earning, in 2008, the market wasn't confident, again, because of the BPO mostly. And it has gone down in 2011 because they had some difficulties, but the market still really did them, and price to book ratio is above 1. It went down, so that's not a good sign for the company, but they're still above 1, so that's alright. And I mean, like I said, they don't have a lot of leverage, and you can see the tide is like amazing, so they really have nothing to worry about for their leverage. The stock price and the expected price in 1 year, they should be doing good. They're actually the best in the industry, and I think the 3 industry. So that's a good company. The only bad side is their EVA is minus 277, and that's due because they had a lot of investment in the US fracking, and it has not been showing as much results as they were expected, but in the future they think that's going to be going up. Supply chain, not much to say about it. It's pretty diversified, so they don't have a lot of risk if they had like their stakes in only one company. Alright, next company is Tidewater. So Tidewater is doing alright. I mean, their liquidity ratio went down a little bit, but nothing really to worry about. What I will be looking at is their assets turnover. That went down significantly, so they're not really efficient with their assets. That's something they need to look at. Also, their return on earnings have been going down a lot. So we know for this industry, it's normal that they have suffered since 2008, but it's still not a good sign for the company. Price per earning, not surprising, went down as well. And the PB is alright since it's still a little bit above 1, but they need to work on it. I mean, they have improved in 2010 when it was under 1, so that's not good. Their leverage, they have a low leverage. It's only 28%, but it's still one of the highest of their industry. So I don't know if it's a different strategy they have, but they should worry about it because their tide has been going down, so they need to look on that. Still, the market is confident. The stock price now is 59.40, and they think it's going to go up to 64.50 in 1 year. Economic value added, like most of the people in the industry, they have a negative of 600. Supply chain, not a lot to say, except their biggest customer is Chevron, but we didn't have much information on their suppliers. Next company is Seco Holdings Incorporation. So Seco, as you can see, their hourly suffered a lot, 2008, 2009, and 2010 again. BPO really affected their industry, and their liquidity didn't go down so much, but still it went lower than most of the others in their industry. Asset turnover is the lowest, so they really need to improve that part. Price per earning has improved, so that shows that the market is pretty confident in what the company can do next. Price to book ratio is really bad. I mean, they are under 1. They're not too far from it, but they really need to work on that part. Profit margin been going down. They're actually pretty low. That's again, they had a lot of fine and things to deal with, and their leverage, it's also 30% on most of the capital structure. So they have one of the highest leverage, if it doesn't show in there, and they don't have the highest tide, so something they need to work on. Stock price, the market is not very confident. Their stock price is right now 86.34, and the thing is 1 year is going to go down to 79. Economic value, negative as well as the others, minus 170. And I didn't even put the supply chain right there. Next company for this industry is the Hornbeck Offshore. Hornbeck did alright. They have improved from 2008 to 2011. They don't have any dividend. What I found interesting was that they didn't have any information on the P for 2011. So the fact that it's so high in 2012, 30.39, I don't know if the market is confident or just hoping they're gonna do good. Price to book ratio just above 1, which is big improvement from 2010. Profit margin, they have lost money in 2011, which is due with the fine they had to pay as well, and all the bad reputation the industry got. Still, last year they've been doing alright, so 2011 was just about here, and their stock price is 55.93, and they expect it to grow to 61.50. Economic value added, I'm sorry, it's negative like the others, minus 170. And their percentage of debt is 44, which is high as well. Supply chain, like the company we saw before, one of their biggest customers is Chevron. Sorry, next company, Gulfmark, not Gulfmark. Liquidity has been going up. They're doing pretty good actually, like all the liquidity we show went up, so that's a really good sign for the company. Sorry. In 2010, if you can see, ROE and ROE were negative. That's because they had to repay. They had to pay 24 million in debt, and they also had a lot of repair to do on their results.